Welcome to Breaking News to Trading Moves. Imagine you show up to rent a commercial space, and the landlord tells you, well, you have to pay for the next few years up front.
Right.
And, you also have to bring your own plumbing, your own wiring, and your own physical infrastructure just to secure the lease.
Yeah, that sounds completely
It
absurd.
sounds absurd in real estate, right? But it is exactly what is happening in the enterprise computing market right now.
Yeah.
Today, the goal is for you, the listener, to look directly at this specific headline driving today's conversation. Oracle rallies after strong AI cloud outlook. What it means for AI infrastructure, semis, and software.
Exactly.
The mission today is to give you a clear understanding of the landscape based strictly on the reported data. We're going straight into the numbers to clearly lay out the winners and the losers. So why does this specific earnings report from Oracle command such immediate attention across multiple sectors?
Well, we really need to frame this entirely around the hard numbers and the market reactions detailed in the text. I mean, this is not about guessing where technology is going. It is a tangible measure of enterprise spending behavior right now.
Okay.
When a company at the center of database management and cloud computing reports its fiscal Q3 data, it gives us, a direct window into the actual budgets of the largest corporations in the world. The numbers tell us exactly where the money is moving.
And the numbers in this Q3 report are incredibly precise. Total revenue came in at $17.2 billion, which is up 22% year over year. But looking at just a top-line revenue number doesn't really tell the whole story.
No, it doesn't. You have to look at the specific cloud metrics to understand the current capital allocation. That is really where the market is focusing its attention. Within that $17.2 billion, cloud revenue rose 44% to $8.9 billion.
Wow, okay. So cloud is now accounting for more than half of the entire business.
Right. And drilling down even further into the architecture, OCI, which is Oracle Cloud Infrastructure, grew 84% to $4.9 billion.
84%.
Yeah, that specific 84% growth rate in their raw computing infrastructure is the data point driving the market reaction. It provides concrete proof regarding the sheer volume of capital enterprises are deploying to secure the computing power required to run artificial intelligence workloads.
But even with that 84% growth in OCI, there's another metric in this report that really commands attention, and it's the remaining performance obligations. That number jumped 325% to $553 billion.
Yeah, that is a massive jump.
When I see a 325% jump in remaining performance obligations, I compare that to, well, a massive venue being booked completely solid for years in advance. People aren't just buying tickets for a show tonight, right? They are reserving the space for the foreseeable future, locking up the calendar. Based on the report, how locked in is this demand?
The report provides absolute clarity on that through the deal structures themselves. Investors were highly encouraged by how these agreements are legally and financially constructed.
Okay, how so?
Well, these are not casual commitments or soft letters of intent. The deal structures involve customers paying upfront for capacity they might not even use for months. And in other cases, customers are literally bringing their own hardware to the data centers.
Wait, really? They're bringing their own hardware? Why would an enterprise customer buy their own servers just to put them inside someone else's cloud facility?
Because the bottleneck in the industry right now is not just getting your hands on the physical servers. The bottleneck is securing the physical real estate that has access to the massive amounts of electricity and industrial cooling required to run those servers.
Ah, I see.
Yeah, a customer might have the capital to buy the computing gear, but they lack a facility with a secured multi-megawatt power feed. So they are so committed to deploying this capacity that they're willing to provide the physical servers and networking gear themselves just to get the floor space and the power within Oracle's facilities.
That is wild.
It is. When clients are paying upfront or supplying their own physical equipment, it demonstrates a highly locked-in level of demand. It proves that the $553 billion in remaining performance obligations is backed by immediate, tangible investments.
Because of this clear proof of real spending on cloud capacity and data centers, the market has identified a specific group of companies benefiting from this demand. Let's move to the winners.
Right. The core takeaway is how the broader market interprets this specific data point. The market reads the Oracle story as proof that artificial intelligence demand continues to drive real, aggressive capital expenditure.
Which is bullish for the suppliers.
Exactly. It is a highly bullish signal for the companies supplying the infrastructure. It validates that the money is actively flowing into the hardware ecosystem right now.
The first group benefiting from this flow of capital is AI cloud infrastructure. If Oracle is seeing this much demand for their specific cloud environment, it tells a broader story about the entire sector.
Oracle's results prove enterprise AI demand remains exceptionally strong. That lifts investor sentiment around the major cloud platforms that have direct, massive exposure to these compute-heavy workloads.
Yeah.
These platforms are the foundational layers providing the environments where these complex models are trained and operated.
And if you are tracking the specific players operating these massive cloud environments, you're looking at ORCL for Oracle, MSFT for Microsoft, and AMZN for $.
Right. Microsoft and Amazon run the largest cloud platforms on the planet. When Oracle posts an 84% growth rate in infrastructure and a $553 billion backlog, the market naturally deduces that Microsoft's Azure and Amazon's AWS are experiencing the exact same spending patterns from their enterprise clients.
Makes sense.
The demand for raw compute is universal across the major providers.
To meet that universal demand, these cloud providers have to build. That brings us to the second group of winners, data center hardware and networking. Oracle explicitly stated they are actively expanding their AI data center capacity. They physically have to pour concrete, build out more space, secure more power, and install more computing capability.
Yeah.
And that directly benefits the companies selling the physical components required for that build-out.
You cannot generate cloud revenue without physical servers, highly specialized switches, and advanced networking gear. The sheer volume of data moving through these facilities requires specialized equipment.
And the companies providing this specialized physical architecture include ANET for Arista Networks, DELL for Dell Technologies, and SMCI for Supermicrocomputer. But, I need to push back on this hardware thesis for a moment.
Sure, go ahead.
If I look back at historical tech cycles, like the telecom boom in the late 90s, companies spent billions laying fiber optic cables and building out physical networks. Once the cables were in the ground and the routing centers were built, the spending completely stopped and the hardware suppliers collapsed. Is this hardware and networking gear demand just a one-off build-out phase? Once Oracle, Microsoft, and Amazon finish building these data centers, doesn't the spending just hit a wall?
Well, the text details that this is ongoing demand across the supply chain, not a single temporary event.
Okay, why is that?
The scale of the remaining performance obligations, that $553 billion number points to a continuous need for capacity. But more importantly, the mechanics of these specific computing workloads are very different from laying a fiber optic cable. This hardware operates under extreme thermal stress and runs at maximum capacity constantly.
So it wears out faster.
Right, it has a much shorter depreciation cycle. Furthermore, as the models become more complex, the networking requirements change. You are constantly ripping out older switches to replace them with higher bandwidth equipment just to prevent bottlenecks. The data centers require continuous expansion, maintenance, and upgrading of hardware and networking gear to keep up with the power density requirements.
The networking gear and the server racks are really just the outer shell. None of that hardware functions without the actual processing power inside, which points us to the third group of winners, AI semiconductor suppliers.
Exactly. The ongoing AI cloud demand points directly to sustained orders for the internal components of those servers. We are talking about the graphics processing units, the specialized accelerators, and the highly complex connectivity chips across the entire supply chain. You simply cannot expand capacity or bring a new data center online without a continuous supply of these specialized chips.
The specific companies supplying that processing power are NVDA for NVIDIA, AMD for Advanced Micro Devices, and AVGO for Broadcom. So the infrastructure side of the trade is clearly defined. We have the massive cloud platforms, the physical hardware and networking companies building the facilities, and the semiconductor manufacturers providing the processing brains.
Yeah, capital is moving aggressively toward these infrastructure winners. The market is following the actual dollars being deployed by enterprise IT departments.
But enterprise IT budgets are finite. A chief information officer only has so much capital to allocate in a given fiscal year. If capital is moving toward these infrastructure winners, it is naturally moving away from other areas. That leads us to the other side of the trade, the losers.
Right. We are seeing capital reallocating away from three specific groups on the weaker side of the trade. It starts with enterprise software under AI pressure.
The text mentions lower seat growth as a primary headwind for enterprise software. I compare this to, well, a manufacturing factory, realizing they need fewer line workers because new automated machinery, which represents the computing infrastructure we just discussed, is handling the output. If a company used to need 50 junior analysts to process data, and now an automated model handles it, they don't need to buy 50 user licenses.
Yeah.
Exactly how does the text define this pricing pressure on software?
There is a very specific debate happening among investors regarding how these tools cause pricing pressure, lower seat growth, or move spend. It breaks down into three distinct pressure points. First, there is direct pricing pressure. As automated models become capable of performing complex tasks natively, traditional software companies might have to aggressively lower their subscription prices just to stay competitive and justify their value. Second, there is the lower seat growth you just outlined. The entire software as a service business model is predicated on adding more human users or seats every quarter. If enterprises require fewer humans to accomplish the same tasks, the software companies simply sell fewer licenses.
And the third pressure point goes right back to the finite IT budget.
Exactly. The third factor is enterprises directly moving spend toward infrastructure instead of software and services. If a chief information officer has to find $50 million to secure cloud compute capacity with Oracle, they are going to fund that by cutting their traditional software and services budgets. The dollars are actively being reallocated from the software side of the ledger over to the infrastructure side.
And the software providers highly exposed to this pressure include CRM for Salesforce, TEAM for Atlassian, and NOW for ServiceNow. These companies built massive valuations by relying heavily on continuous seat growth and maintaining strict pricing power for their monthly services.
Yeah, when the market sees $553 billion committed to cloud capacity, they immediately question how much is left over for traditional per-user software subscriptions.
That dynamic leads directly into the second group on the weaker side of the trade, higher multiple cloud software.
This specific group is categorized as a broader market rotation call. In financial markets, high multiple stocks are companies valued at massive premiums based on the expectation of flawless, rapid growth far into the future.
Right.
When the market receives a strong infrastructure signal like the data Oracle just provided, money naturally rotates away from software names that lack direct exposure to compute and capacity growth.
And if you're watching this rotation, the tickers mentioned explicitly are SNOW for Snowflake, DDOG for Datadog, and MDB for MongoDB.
The capital is simply moving away from these higher multiple software names because investors are reallocating their funds toward the clear infrastructure winners. If a high multiple software company experiences even a slight slowdown in growth because IT budgets are being consumed by hardware purchases, their premium valuation collapses. Investors do not want to hold high multiple software when the underlying enterprise spending data clearly points toward hardware and compute.
That leaves us with the final group feeling the pressure, legacy enterprise tech.
These are the slower growth technology names lacking a clear AI infrastructure tailwind. They operate in mature, traditional IT segments. Because investors and enterprise buyers are so intensely focused on actively building out high-performance capacity, these legacy companies are attracting much less interest from investors.
The legacy names to note here are IBM for IBM, HPE for Hewlett-Packard Enterprise, and HPQ for HP Inc.
Right. In a market environment where capital is moving aggressively, there is an opportunity cost to holding stagnant assets. Without a clear, direct link to the massive infrastructure spending happening right now, these legacy names struggle to capture investor capital. They become dead money in a market completely focused on securing compute capacity.
Let's summarize the core factual takeaway from the data we've covered today. Oracle's results strengthen the bullish case for AI infrastructure, semiconductors, networking, and cloud capacity. The builders.
The data presents a very clear divide in how capital is being allocated.
Right, while at the same time, it leaves enterprise software as the weaker side of the trade due to valid questions around demand and pricing.
Exactly. The money is flowing heavily toward the physical components and the raw compute capacity, while reallocating away from traditional software models that depend on human user licenses and legacy IT environments.
I want to leave you, the listener, with a final thought to mull over based on what we've covered today. We talked about how the traditional software as a service model relies on selling individual seats or human user licenses. If AI tools continue to create pricing pressure and lower seat growth for enterprise software, what will the software business model actually look like a few years down the line while the infrastructure side continues to build out? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.